Yo guys, what is up? Len back from LK Street. So today we're going to be talking about stocks and mutual funds. Let's hop right into it. What is a stock? Not a lot of people know what a stock is. Well, a stock is actually a share in a company. And that share in a company can go up in value over time and be worth more than what you bought it for. I'm going to explain how and why that is. Okay, so how does that happen? Well, let's say I invest $5 into Len Incorporated, getting me one share of that. So that one share is worth $5, right? So over time, Len Incorporated, let's say it's a clothing brand in a small town, one store, does $20,000 of sales per month, $120,000 a year, is a good store, does okay. It then goes viral. The brand goes viral, provinces start having this store, it franchises out, goes across the country, and that $5 that I paid for that one share, I can now sell that share for $100, giving me $95 for profit. Alright, so let's talk about the risk. Well, the risk has something to do with the company. So if a company starts doing bad, let's say Tesla releases a car and its battery starts blowing up and their car sales go down and people don't want to buy Teslas anymore, and so that's going to really hurt the company in sales. So that stock is not going to be worth that much anymore. So right now it's at $190 US. So let's say that car came out, bad battery, started blowing up. Well, now that stock is worth $120 US. So now if I wanted to sell that stock that I purchased for $190 US, I'd be actually losing $70 because it's now only worth $120. So that's the risk involved. So the risk is actually the company doing bad, going bankrupt, they have a flaw in their system, a new company comes out with a better item of what the other company that you had, just like anything to involve the company doing poor. So let's talk about the return. Well, the return is pretty much simple. It's my investment going in and getting a better amount that I put in out. So I put $5 into Len Incorporated, a clothing brand in a small town, does $120,000 in sales a year, is a good store, one store only, and it goes viral. The clothing is unreal. People are like, oh my god, I need this. Stores go across the country, it franchises out, and now that share is now worth $100. So I make $95 in profit. And that isn't the only way that you can profit from a stock. Sometimes, most often, companies give out dividends, and that's decided on the majority of shareholders. So there's going to be a board of shareholders that have the majority of the shares, and they're going to decide whether to give money back to the shareholders or to put it back into the company. And sometimes putting it back into the company is good because that can boost the stocks and the price. So instead of getting the $1 back from the dividend that they were going to give to all the shareholders, you get $5 because now, because of that money that they put in, they had new research and a new device came out, and instead of the stock being $120, it's $125. And so then you get profit from that. So a dividend is just money given to the company back to the shareholders. So I have a share from Len Incorporated and they say, hey, we're gonna give $1 back to every shareholder, and so now I get $1 back. And that's good because now that $5 that I put in, I got $1 back. So really now it's only a $4 investment. So now let's talk about a mutual fund. Well, a mutual fund is actually just a bunch of stocks all in one. So it could be a bunch of different grocery stores like Save-On, Safeway, and Sobeys, and you could be investing in all three instead of just investing in one. And that has less risk because, say, Sobeys had a bad year because their veggies had lots of pesticides on them, and they were just yucky, so a lot of stores were not carrying veggies and they lost a lot of sales. But let's say that Save-On did good, and so did Sobeys, so did Safeway. Well, now you don't have to rely on just one company doing good. You can rely on 3 doing good. And that sounds a little bit weird because, oh, why would I want to rely on 3? But in reality, it's actually because the odds are less slim for that company doing poor because there's 3 different ones. Mutual funds can tend to have less return because you have to pay management fees. Those management fees go to the manager in charge of the mutual fund. So they would decide, okay, let's get 3 stocks of Sobeys, 2 stocks of Safeway, and 1 stock of Save-On. So they're managing the mutual funds. A lot of people will put stocks or mutual funds into 401k or IRK accounts because then you won't get taxed on the money that you can make from them. So it's for retirement. So let's say I bought a $20 share in a company and it was now worth $200. So that $180 that I made from that company, I won't get taxed on anymore. So I would get that $180 and I wouldn't have to pay tax on it, which can actually save you a lot of money if you decide to buy a lot of shares. Alright, so I hope you liked the video. Click the thumbs up if you did. Make sure to subscribe, and I'll see you next time.